Those difficult decisions decides whether you become a really good trader or not, I believe. I don't think you can just systematically remove that just by having a really brilliant system.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. It's Walter here. Hello, Darren.
Good evening, Walter.
So we're going to talk about this idea of systems today and trading a lot of systems. And yeah, I don't know why. I used to think that, when I first started trading, I thought that if you were a trader, you had like this whole swath of systems, and that's kind of how, that's how you approach things. You had all these bells and whistles and monitors, and everything was just firing off, and it was this real exciting thing. But I'm curious, like, what do you think in terms of systems? Are there advantages or disadvantages, or how do you view it in terms of trading multiple systems, or should you just stick to one?
Yeah, well, it's an idea that I'm kind of playing with right at the moment, and I know we touched on this the other week, and I've kind of always gone down that mentality that, you should have like a core system, and you might trade a few variations, but generally you work on a system and perfect it, and that's the system you trade. But more and more, I'm kind of realizing that having other systems gives you some diversification. With any kind of investing, they say you shouldn't put all your eggs in one basket. At the moment, in that sort of exploration period where I'm trying to get two systems that kind of work really neatly together. So, for instance, when my main system is not making money or losing, the other system is making money, and vice versa. And the idea is, I know that there's going to be periods where I just lose money and there's nothing I can do about it. It's just particular market conditions don't work for my system, and I think all systems have that to an extent. And I'm just trying to find ways that reduce the damage of those. And then in the times when my primary system's working really well, the other one just doesn't really generate any entry signals. So I'm kind of looking at it from the entry point of view. So I'm saying, what is the distinguishing character of the market movement when I'm not making money? And how can I design an entry system that will work then? I think if you come at it with some sort of plan, then it can be something really good. And obviously, I haven't got any results to back this up yet, but I have noticed that a lot of traders that have been around a long time and have been very successful do trade multiple systems. So there's obviously something there.
Yeah, and obviously, like the people who are into the automated stuff, that's kind of, or even a lot of funds will do the same thing, where they do exactly what you say, Darren, which is you have some system, maybe it works in a trending market, another one works in a directionless, choppy, consolidating market. Maybe you have a breakout system that works kind of at the open or a specific time of the day. And one thing that's taken me a long time to get used to is this idea that I might have a signal that's a buy, okay, on let's say, like, for example, right now, I have a trade that bought the New Zealand dollar, US dollar. So it bought Kiwi and sold the USD. And at the same time, looking at the charts, like I really want to sell the Kiwi USD with another system, So it's taken me a long time to get to the point where I can say, you know what, that actually makes sense. So just because you have this buy that was put in months ago for the Kiwi and it was triggered the other day, like 2 days ago, doesn't mean that you can't take a trend trade in the downward directions. In other words, a trade against this, because it could be a situation where both trades work out. It could also be that only one works out, but it could be that, let's say, the buy trade on the Kiwi goes to target one, and then the rest of the trades at break even, and then it comes back down and stops you out at break even. And meanwhile, now you've got a sell signal to go down with that downtrend, so you're continuing on in the downtrend. That sort of thing. So that was something that it's difficult, I think, if you feel super committed to your trade and you feel like you're doing the right thing. It's hard to actually take the other side and go, you know what, I'm actually going to take on another account. I'm going to take another trade here that's a little bit different. And it's easier, I suppose, if it's a different time frame or something like that. But sometimes people, at least I have found that difficult to get to that spot where you can actually do that.
Yeah, and there is that. Obviously, there is that sort of negative kind of thing around looking at other systems as well. Where you're system hopping, and you need to be careful that that isn't what's going on. You really need to be looking at a large sample size of data to see when and if you need to trade another system to diversify. It's very difficult as well, because psychologically, when you're trading a particular approach, you're kind of building yourself to believe in that particular system, and then to at the same time take on a system which kind of contradicts those beliefs. It is difficult to do, because you're kind of saying, well, this system isn't perfect, and then you start questioning, well, should I be trading it if it's not perfect? So again, you need to go back to that thing where you accept that no system is going to be perfect. I think it's unreasonable to accept any system is going to work in all market conditions. So you're always going to have periods of drawdown, and there's always going to be variances in those. So sometimes they're going to be a lot worse than what you tested. So there's a lot of psychological issues with taking on another system.
Yeah, and performance as well. Like, let's say that you had a trend system and then a reversion to the mean system, and you're running them both at the same time. Like you say, sometimes you're going to be doing really, really well when the market's trending with your trend system, and then maybe not so hot with the reversion to the mean system. So in a sense, you're kind of waving the white flag and saying, I'm not going to have these huge chunks of profit that come into my account and add to my account, because it's going to be blunted by the other system. In exchange for that, I kind of smooth out my equity curve in theory, and I kind of have shallower retracements. But in the end, what I'm doing here is I'm sacrificing some of those high peaks by creating shallower valleys, shallower drawdowns. In theory, this is the way it works. So it's a little bit tricky, because I think sometimes people, if they have a good month, they want to draw a straight line and go, okay, this is, I made 12% this month, so let's multiply that out. Okay, whatever, I'm going to make 144% on the year or whatever. But when you start adding more systems in here, what you'll notice happens, especially if they're not very similar at all, is it will kind of even things out a bit. And sometimes that's difficult to take. I know that for most traders, the drawdown is really the uncle point where you get stopped as a trader, where you give up, where you change, where you throw in the towel, where you take a break, where you change things drastically, is because of the drawdown. So that can be good that you're blunting those drawdowns, but at the same time, you're also blunting your overall performance. In theory, that's what's happening.
Yeah, and I think also you need to accept that sometimes systems will just stop working as well. Your system might be based on a particular market occurrence or movement that's happening, that for some reason, because of, I don't know, something could change, it's going to stop working. Maybe you trade the Friday close or something like that. You can find systems that worked really well for 5-10 years, on a particular instrument, and then will stop working. So I think it kind of gives you a little bit of insurance as well going forward, if you've got one or two or even more systems that have a positive expectancy. And I think it's a little bit naive as well to expect you're only going to find one system that's got a positive expectancy. If you kind of understand the core elements that make a system profitable or not, you should really be able to not just make variations of that. You should be able to kind of use some logic and build other systems based off those ideas.
Yeah, absolutely. Yeah, and the way I approach it is a little bit weird. I think maybe it's just I want to have control, but the way I approach it is I look at the charts and then I say, okay, now what sort of system should I be using here? Because some are going to work better than others. If I look at a trending chart, immediately I'm thinking in certain, I've eliminated several different types of trades because I'm looking for a trendy type of trade. And I know that, if the market's trending, hopefully it'll continue trending. If it doesn't continue trending and I use the trending systems, then I'm going to lose or at best break even on these trades. But if I see a trending market and it's going to keep trending, then my trending systems in theory should work quite well. So, and the same thing with the directionless market. If the market's directionless, then I'm looking for those systems that are going to work in that style of chart really is the way I see it. But what's interesting, I think, about what you just said is this idea that systems stop working. And I've always had a really hard time trying to distinguish between a system that's no longer working and a system that's just simply in a drawdown. You know, and I don't really know. I mean, there statistically, I guess there's some things you can do, you know, relying on parametric statistics and say, well, we know that this kind of a drawdown, this sort of a losing streak is beyond, say, 3 standard deviations. So it's very, very unlikely that this is still a part of this distribution of trades. So we're looking at a different distribution now. In other words, the system has changed, or the market has changed, and the system no longer applies as it did historically. So, I mean, you could do things like that, but other than that, I don't really know. I mean, to me, it's just the trader decides. The trader says, look, this is too much. This is too much. The drawdown's too great, and something's wrong here. I got to stop. I mean, I don't really know what the solution is to that, other than to try and use things like standard deviation and sequencing. Like you go, you know, with this sort of a win rate, I'm likely to see 7 losing trades in a row 1 out of 10,000 times. You know, if and then you see your 8th losing trade in a row, you go, okay, hold on here, something's wrong. Assuming, of course, that your stats are correct and that you're applying statistics in the correct manner, which, of course, we talked about this before. In trading, that may not be the case because you have so much variability and so much volatility in the markets. But yeah, so what are your thoughts on that? Because presumably, if you have multiple systems, at certain times you can shut them off, turn them off, throw them away. So how do you know when it's a drawdown versus it's broken?
Yeah, well, that is the big nightmare, isn't it? Because I believe that systematic trading relies on letting the system run for a long time. And because you're going to get variance in your results, you kind of need to let it play out over the long run. In other words, just because this drawdown is worse than any in your testing period doesn't mean that the next period is not going to be better than any in your testing period. There's that variance always, and there can be just, you know, one particular period, say a few months, where the system performed really, really badly, and that particular pattern of movement and entries may never happen again. So you're kind of stuck in this dilemma of, you know, do you just bite the bullet and say, right, I know that this has a good chance of being profitable over the long run, but you need to let it run over the long run and then just grinding it out? Or do you, like you say, at some point step in and say, right, this just isn't good enough, I'm going to have to stop it? And I think you kind of need to do that a little bit. You need to just say, you know, there's nothing wrong with saying, look, the system's not making money now. It's worse than my expectations were for the drawdown periods. So I'm just going to pause it for a bit, and I'm just going to perhaps trade in demo or just observe for a bit. There's nothing wrong with you know, doing that. I think, you know, all trading comes down to those difficult decisions that can't be predetermined. And at some point you've got to weigh up all the pros and cons and make a gut decision, and those happened all the time in, you know, with entries, with taking profit, with position sizing, with whether you're going to stop trading a system or not. And that is the difficult bit, and it goes over all of trading. Those difficult decisions decides whether you become a really good trader or not, I believe. You know, I don't think you can just systematically remove that just by having a really brilliant system.
Yeah, absolutely. I think you can sort of say, look, based on what I know, this system really, it's highly, highly unlikely. Let's say a 1 in 10,000 chance of hitting 7 losers in a row. Okay, so if that's the case, what that means, of course, is you have a relatively high win rate for your system. And so then you go, all right. And the other thing is, if I'm risking X% per trade, and this is the way I'm going to use position sizing with this system, then knowing that I'm unlikely to have 7 or more losers in a row, then I'm unlikely to have a drawdown of X%. Let's call it, 16%. So I'm unlikely to have a 16% drawdown. So based on all this that I know, if I get to the point where I have that 7 or 8 losing trades in a row and I hit the 17% drawdown, I can just have an automatic shutoff. Go, okay, that's it. Move it to demo. We'll see if it pulls out of this, from demo. But basically, it's gone too far. The data that I have doesn't fit because either the markets have changed, my system's no longer doing what it used to do historically, or I'm not executing it correctly. So there's an error somewhere. Something's going on here. It just doesn't add up. So if you have those things in place beforehand, because these are emotional decisions that people make, and they want to take revenge and get their money back and all these things, when it happens in real time. And so I think it's a little bit easier if you plan it ahead and you say, okay, this is what I'm going to do. If this happens or this happens, we go to demo, we pull the plug, blah blah blah. These sorts of things.
Would you say that in general, retail traders trade multiple systems, or do they tend to focus on one? Because my feeling is that generally people will trade one system, and then when they add another system, they'll remove the first one. So they'll just switch systems. What's your experience with that?
Yeah, well, I think the more experienced traders are better at juggling. But in the beginning, yeah, I think a lot of traders are like that. But I don't know. I mean, I think it depends. So, for example, let's say you're 57, you're retired, and you and your wife are just trading. Like, you don't have much going on. Okay. Well, maybe you do have 4 or 5 systems running. Maybe that's the way you do it. Okay, let's say you're 31, you've got a job, and you work from 7. You're out the door at 7 in the morning. You come home at 7:30 at night, and you really don't want to sit in front of the screen from 8 p.m. to 1 a.m. trading the London market or whatever, right? So, are you really going to be able to juggle 4 or 5 systems? I mean, I suppose it depends on the time frame. If that it's possible, but and I think you nailed it earlier when you're talking about this, about having like the perfect system. I think when we first start trading, that's what we're seeking the perfect system, and then as we get experience, we change and we go, no, that's not, and that's why diversification works, and diversification of systems is going to beat diversification of markets. And I think, and I would challenge anyone listening to this, go out and test this. Test this idea. Don't think, oh yeah, well, or maybe you should think, hey, you don't know what you're talking about, Walter. But I challenge you to go out and test this. Test different systems on the same market versus the same system on multiple markets, and come back and let me know how it works. Because generally speaking, as long as you have systems that are completely unrelated, I'm not talking about 2 trend following systems or 2 breakout systems, I'm talking about 2 very different systems. That's a better diversification than to go and trade multiple markets. So that's what I would encourage people to do. If this is something that makes sense to you, if you're comfortable with your system and you want to add another one, try and add a really, really different one, because then you'll be taking advantage of what we're talking about.
Yeah. So let's say for instance, we were trading on the 4-hour time frame, and we were using say support and resistance, and we're looking for a breakout and retest. So kind of like a trendy support and resistance system. Where would we start?
Yeah. And Dennis, our friend Dennis does that. Dennis in the I'll put a link to his account so you guys can see it. He's a really good trader. He's in France, and he's on that Signal Start webpage or whatever. He's quite highly ranked. He was number 1 for a while. But that's exactly how he trades. That's the only reason I mention it. So he trades exactly like what you just said. Yep.
Yeah. So where would you then start to look for a system that gives diversification to that?
To that, yeah, right. Great question. So let's say you're trading the 4-hour trendy move where it breaks out, comes back down, touches, and bounces off that, and you expect it to continue in the direction of the trend. All right, so what are you going to do that's going to trade different to that? Well, you could trade a 4-hour system, right, where you're basically trading off of boxes, or maybe you have Bollinger Bands or something like that, where you have some sort of envelope and you're waiting for the market to get to the extreme end of the envelope, right? And then you sell it or buy it back to the median, to the middle, to the moving average in the middle. So that would be an example of a system where you could do that. Now, you don't have to have the Bollinger Bands or whatever. You could also just draw a box. You wait for the market to get into a 4-hour box, and you wait for it to get to the edge of the box, and when it prints a bullish candle at the bottom of the box, you buy, and you buy it all the way up to the middle or the other side of the box, and if it gets to the top of the box and prints a bearish candle, you sell down to the middle or the other side of the box. That would be a very simple sort of mean reversion style of trading that would probably be quite unrelated to a trending 4-hour system.
Yeah. So in essence, on one system you'll buy in an uptrend, and then in the other you're looking for price to get overextended and getting those retraces back as well.
Yeah, so you're making money on the retraces. Whereas with the trendy, you're doing the opposite, aren't you? You're waiting for the retrace to be, quote, over, according to your signal. The retrace is over, and now it's gonna keep exploding in that trend direction, whether it's down or up. So it's kind of the opposite.
Yeah. And when you actually break it down and think about it logically, it kind of makes sense, really, that at least two systems that are opposing, could work really well together. It's surprising that I've not really tried it before.
Yeah, but you have traded different ways. I know that for a fact. Like, you used to trade with the trend and stack the trades and occasionally just hit it out of the park, right? Like, you would just, to use a baseball term. Yeah. I mean, that's...
Yeah. But I always kind of switched from one to the other, and I never really kind of got the two to gel together. And it's quite difficult, You're kind of you're expanding the amount of decisions and just the sort of mindset that each system's gonna have to deal with. So you're gonna have to plan it and be organised and practice it as well. But yeah, it's certainly from a logical point of view, you can see that that's a really good way to trade.
Yeah, absolutely. Yeah, and the other thing I just want to mention, because I think you brought up a really good point, was we were talking about having enough trades or enough data so that you kind of have a good idea of what's going on, at least historically. One thing I'll mention about this, because I don't think it gets mentioned enough, and I know it's kind of contrarian to what most people will hear, or what you'll read in trading books or whatever. So I think maybe you'll like this, Darren, because I know you're like me. I mean, we tend to. Maybe you more so than me, but I really whenever I read something in like the business paper or whatever, I think, why is that here? Like why do they want us to think that? I'm always thinking the other side, right? But what you'll hear is they'll say things like, you need X number of trades to verify that your system is good enough, okay? Or you need X number of trades to know if it really has an edge or whatever. And they'll throw numbers out there, 100 or 30 or whatever, and they'll say that. But here's the flip side to that. And this is like, you can check this in science. You can go to your local university and ask the statistics professor this, or experimental design professor this. You can ask them this question, which is, if you had two experiments, and we're talking about trading systems here, so we're talking about backtesting, but in essence, they're experiments. You have two experiments, and one experiment shows a huge effect, okay? In other words, the placebo versus the pill made a huge effect, but they only had 10 subjects in the experiment. And the other one shows a small to moderate effect, but they had 10,000 participants in the study. Which one is more impressive? Now, there's always going to be that argument that, well, we only had 10, so maybe we just got lucky, and we kind of made a mistake here, and even though it's showing an effect here, we need a larger sample. But here's what they don't tell you. What they don't tell you is that when you have 10,000 subjects, when you have 10,000 participants, you're almost guaranteed to get the result. It's almost guaranteed, because it's a question of power. So another example would be, let's say you have a telescope and you're looking out in the stars. If you look out through your telescope and you see this big giant white thing out there, and you go, "Whoa, that looks like the moon." That's the moon I see, right? Well, the reason you can see it is because the moon is so close, it's so big. You don't have to have a very good telescope to see it. In fact, you can see it without a telescope, right? But here's the thing. What if you had a really, really, really strong like the Hubble telescope, and you're looking far, far away, and you see a speck out there, and you think, wow, that looks like a planet. That may be a planet over there. We think that's a planet, but we're not really sure. Well, the thing is, that could just be like a speck of dust or something on the lens. It could be lots of other things that it's not really a planet, but we're able to possibly see it because the strength of the telescope is so strong. Well, when you have a really strong effect, when you have a really strong trading system, when you have a system that really, really works, it's got a really positive expectancy, you're going to see it show up sooner than you would if you had a system that has sort of a moderate edge. So in other words, if you take 20 trades and you're seeing a huge profitable system here, it could be because you just got lucky on those 20 trades. That could be the case, but it could also be because that effect, that edge is so good that it's shown up, and you don't need to take 500 trades to see it. Now, I'm not suggesting that you should only take 10 or 20 trades and then decide to trade a system live. That's not what I'm saying. What I'm saying is that the flip side to, having X number of observations to be sure that something is true is that the really powerful things will show up quickly. And you don't need to have a powerful experiment or a powerful back test to see it. And I think this is something that's, people don't think of this. They don't realize this is the case. So I want people to keep that in mind too when you're looking at stuff. If you've got a good system, it'll probably show up rather quickly. You'll know right away. You don't have to go through the whole 1,000, back test trades to see it.
Right, yeah, I'm with you now. I for a minute there, I was thinking, no, what's he talking about? That's wrong.
Yeah.
But I get your point. If the system is solid, then 100 trades should give you a good result. It's highly likely to give you a good result. And from there, you don't waste. I mean, if you do 100 trades and it's really terrible, the chances are it's not really going to get any better over the long run.
But you could find an edge if you keep going. That's you know what I mean? Yeah.
Yeah, do you want to take 5,000 trades to make 3% profit? No, you want you want it highly likely that over 100 trades that you're making a decent profit. Okay, I see what you mean. Yeah, because that luck element plays into it a lot. And when I did a lot of back testing at the start of this year, trying to remove some of the discretion in my systems, and I only found one period that was really, really terrible, like a 3 or 4 months in 2014. It was terrible. And generally, I tried 4 or 5 different ways of managing my trades, different exits. And generally, they were all putting in really nice, profitable periods. So I agree with you on that. If the system really has an edge, then it'll show up in a smaller sample as well.
Yeah, it's just power, the power of the back test, and your power goes up as you get more observations. That's all it is. And like you said, if you can keep going, and you'll probably find something. Like you go 120 trades, and you're like, I don't know about this. Well, if you keep going, if you plug along and do 900 trades, well, maybe you will find something there. But is that really going to be worth it? Is that going to be something that you want to do? Like you say, is that worth the 3%? Is it you going to take 900 trades to make 3%? Is that really going to float your boat? So yeah. All right. So Darren, basically what we're saying here is, it probably does make sense to diversify your systems. That would be my suggestion, that it's something that can possibly help. You're probably not going to have the really, the excellent months or weeks or days or whatever that you would if you were just trading one. But it kind of reminds me of, like, I have this system, and I know it's a losing system, okay? People, you don't have to write in and tell me, hey, Walter, that's a losing system, because whenever I go to, like, a casino or whatever, Vegas, there's a system that you can play on the roulette table, and maybe I'll put a link to it in the show notes. But basically, what you're doing is you're betting, let's say you bet on black, right? So about half the numbers you'll win, and then you put another bet on a third of the numbers, and that third actually has mostly red numbers. Okay, so if you hit on black, it's a 1-to-1 payout. So you put $50 down, and a black number comes up, you get your $50 back. Okay, but then you put another bet. Let's say you put $20 on that third, right? Now what happens on that third is, most of those numbers are red. So you actually, some of them are black, but most of those numbers in that third are red. You actually will get paid if about half the numbers come up, which are the black numbers, and then a few of the red numbers too, if those come up. And I think there's 13 numbers in that strip, and maybe 8 or so of them are 8 or 9 of them are red. So if those come up, then you get paid 2 to 3 or whatever it is, 3 to 1. Yeah, 3 to 1. 3 to 1. So you get $60, right? So the best case scenario would be that it lands on a black number so you get $50, and then it also happens to be one of the 3 black numbers in your other bet, right? So then you get $60 paid out for the 20 bet, so you're actually making 110. But that rarely happens. Instead, what happens is it kind of you get the black a lot, and then a few times you'll hit a few of the red, and you're just able to keep playing. You're going to lose over the long run. There's no edge. But what it does enable you to do is it keeps your bankroll going, and that's kind of the same thing that happens when you have diversification of systems, isn't it? It allows you to keep going even when you're going through kind of a rough patch, because one of those is likely to make a little bit of money for you, whether it's the breakout system or the trend following or whatever. So I think it makes a lot of sense to diversify. And as you get good at this stuff, you realize that not all, there's certain markets where your system's not going to work well in. Okay, so now let's design a system that will work well in that style of market. And then that's really the key, I guess.
Yeah, and exactly where I'm sort of focusing my sort of efforts at the moment, trying to work a range trading system to go with my kind of breakout system, and looks pretty good so far.
Awesome, sounds cool. All right, well, thanks for your time, Darren, and we'll see you next time.
Okay, cheerio, Walter.